Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go. The global precious metal market value was valued at $193.30 billion in 2020 and is expected to grow at a compound annual growth rate of 9% in terms of revenue from 2020 to 2027. Gold and silver are the leaders of that market, followed by copper, platinum, and palladium. Precious metals were traditionally considered as inflation hedging tools, and they also served as safe haven against stocks market crash. And as such, their link to inflation and other hazards have been thoroughly investigated. Past researchers have used artificial intelligence (AI) systems to try to predict precious metals price trends. However, not much evidence has been gathered concerning algorithmic trading systems designed for intraday futures in general, and particularly precious metals futures. The main objectives of the following research is to fill that gap of knowledge and examine whether short-term price of precious metals can be predicted and which tools should be used for that process. The short-term precious metals price prediction is important not only to precious metals traders but also to managers of stocks and currencies portfolios. Moreover, the short-term price movement of precious metals can indicate on general economic imbalance concerning other risky assets such as stocks, bonds, and real estate. The following research uses machine learning (ML) algorithmic trading strategies that use the relative strength index (RSI), oscillator, and Keltner channels (KC) as our primary technical tool. We utilize different setups of these tools to achieve best performance of the AI systems. In recent years, investors have realized that AI systems are necessary tools to process efficiently huge amount of financial data and replace many hours of human analysis. That data is consisted of financial market data and social media data. Researchers have realized that the financial markets are highly responsive to social media influences and therefore develop deep learning models that can be used to extract incredible information that buried in a big data. Intraday in the financial world describes securities that trade on the markets during regular business hours. Traders pay close attention to intraday price movements by using real-time charts to benefit from short-term price fluctuations. The advantage of intraday trading is that it is not exposed to after-hours news that can change price direction dramatically. Such news includes vital economic and earnings reports, as well as broker upgrades and downgrades that occur either before the market opens or after the market closes. Intraday trading relies heavily on algorithmic trading and AI machine learning, since speed and accuracy is essential in such fast, dynamic environment. Not many researchers have analyzed different trading strategies suitable to precious metal trading systems. Chin and Cowibian documented a significant differences both across and within commodity groups. Precious metals fail most tests of unbiasedness and are poor predictors of subsequent price changes, but energy and agricultural futures fare much better. These findings of Chin and Cowibian motivated us to search for algorithmic systems that will be able to predict intraday prices of precious metals. For that reason, we designed and optimized 3 algorithmic trading systems suitable for precious metal futures trading. Our system is based on advanced trading strategies that have never been examined before for intraday metals price prediction. The Relative Strength Index, RSI, is a momentum indicator developed by Wells Wilder, which compares the magnitude of recent gains and losses over a specified period to measure speed and change of price movements of a security. This technical oscillator was proven to be an effective tool for stocks trading for different time frame. For example, Bhargavi et al. Concluded that the RSI can be effectively used in the construction of portfolio. It can be used both for short-term investment and long-term investment. It accurately predicts the buy and sell signals for different stocks. The Keltner channel (KC) strategy was first introduced by Chester Keltner in the 1960s. The original formula used simple moving averages, SMA, and the high-low price range to calculate the bands. In the 1980s, a new formula was introduced that used average true range, ATR, as measures of volatility. KC formulate graphic channels that enable AI system to recognize and preform actual trading. However, because of its optimization complexity, it is seldomly used by AI systems for intraday trading tasks. We designed two trading systems using RSI and KC algorithms and optimized their setups using particle swarm optimization, PSO, for best trading performances and tested their ability to forecast intraday price trends of 5 major precious metals: gold, silver, copper, platinum, and palladium. Figure 1. Linear regression algorithmic trading strategy. Notes: every candlestick in Figure 1 represent the high/low open/close of the commodity futures daily prices. The middle line in Figure 1 represent the linear regression line, while the other two lines represent one standard deviation from it. A linear regression strategy demands the length of time for the line formation and the span from that line that determines the entry and exit from the trading positions. The regression line in Figure 1, for example, is based on 50 trading days when one standard deviation from that line determines the entry and exit points to the trading position. We started our PSO procedure with a random variable for both the daily time length and for the span that determined the actual entry and exits of trades. The system altered those variables in order to maximize our trading targets. Figure 2. Darvas boxes algorithmic trading strategy. Notes: every candlestick in Figure 2 represent the high/low open/close Bitcoin daily prices. A green daily candle means that the close price is above the opening price, and a red candle means that the close price is lower than the opening price. The green and red lines indicate the upper and lower boundaries of Darvas's boxes. Figure 2 show how Darvas boxes are designed and how they generate a long and short signal. This algorithmic trading system assumes that the trader is always exposed to price shifts between long and short positions. Darvas boxes use the notation that deviation from overtime horizontal support and resistance lines can be used to construct a winning trading strategy. The idea is that the asset's price should move within a specific box formation when no external news is provided and break formation when important news concerning the commodity is introduced to the financial markets. Boxes can be formed using any predetermined time frame according to the financial asset's volatility. A high volatility financial asset demands a shorter time frame for box formation than a low volatility asset. The PSO process starts with a random number of days to construct the boxes and alter them to achieve better trading performances. Once the size and shape of the boxes are formed in the training period, it is used for the tested period for which performances are remeasured. The PSO procedures start with random setups for both the moving average and the standard deviations and optimize both particles of our trading system. The three methodologies that were tested in this research are based on the pattern recognition of price movements of the precious metals. The LR tries to adjust a linear model, horizontal or diagonal, to the data and determine price direction through a deviation from that linear formation. The DB methodology works on a shorter-term formation of boxes that represent the horizontal support and resistance lines. A deviation from that formation can be used to identify price trend shifts and support trading decision-making. The concept that lies behind the BB structure does not demand the identification of a predetermined formation but rather determines a zone in which the financial assets are expected to move within a specific time frame. A breakout of the price from the expected zone can indicate irregularities of movements and can be used to make profits. We start the results section by presenting 10 years of, until the end of April 2021. Monthly and daily correlations matrix between the returns of the examined precious metals. From Table 1, we learn that all examined precious metal monthly returns are positively correlated. However, on a daily level, the correlations between the precious metals prices do not have the same sign. While gold and silver and copper and silver are negatively correlated, platinum and palladium and silver and platinum are positively correlated. We now apply to the daily data our designated multidimension regression model, equation 1, and report the results for the standard stepwise regression model is presented in Table 2. This model enables us to better understand the 1 to 3 day lag dependencies of each metal to its previous price changes and to the other precious metals. Table 2 show an interesting phenomenon: all precious metals' current daily returns are negatively autocorrelated to their former day's returns, gold and silver to their former 3 consecutive days' returns, platinum to its 2 consecutive days' returns, and copper and palladium to their single former day returns. In terms of interdependencies, Table 2 exhibit that gold current daily returns are negatively affected by silver's former days returns. However, silver's current daily returns are positively correlated to gold's returns 2 and 3 days ago. Platinum's current daily returns were found to be positively affected by gold, silver, and palladium's past returns. Palladium's current daily return was found to be positively correlated to yesterday's returns of silver and platinum and 2 days ago of gold's returns. The observations described above about the precious metals daily autocorrelations helped us better understand the fluency of daily prices to construct our trading strategy. All the design trading systems are based on daily trading data. However, because of the different nature of these strategies, the number of days used for each of them, which is determined solely by the optimization process, is different. For example, the linear regression system needs more days than the other methodologies to construct its formations. Therefore, the algorithm needs a higher number of days to analyze the price trends and produce profitable trading signals than the systems that are based on Darvas boxes and Bollinger bands, which are more dynamic in nature and demand fewer days to achieve their best performances. In this research, we examined the short-term behavior of 5 major precious metals and tried to determine whether prices can be predicted and traded accordingly to algorithmic trading systems. By using a multidimensional regression model, we found that all precious metals' current daily returns are negatively autocorrelated to their former days' returns. Gold and silver are negatively correlated to the former 3 consecutive days' returns, platinum to 2 former days' returns, and copper and palladium to a single former day's returns. The model also identified lagged interdependencies among the examined metals. These findings helped us to better understand the daily price fluctuation of each metal and to improve the trading systems. The trading systems used 3 forecasts: methodologies, linear regression, LR, Darvas boxes, DB, and Bollinger bands, BB. Our data consisted of 20 years of daily price data concerning 5 precious metals futures: gold, silver, copper, platinum, and palladium. During that long time, the precious metals experienced high and low price volatility under different economic conditions. We used PSO as our primary optimization tool because of the complexity of our target function. For that optimization process, we split our data into 2 equal time periods: 10 years of training and optimization of our system and 10 years of testing and reporting results. We found that it is possible to forecast the short-term price trends of all the examined precious metals. Moreover, we documented that our system better forecasts price uptrends than downtrends for all examined techniques and commodities. Our systems best predict silver future prices and forecasts platinum prices the worst. Linear regression was found to be the best forecasting technique for silver and gold price trends, while the Bollinger Band technique best fits palladium. This research has proven that precious metals prices can be predicted using an algorithmic trading system and, therefore, can be used by researchers, traders, and hedgers. Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.